Hi, I'm Jeffrey Panic, Managing Director of Balance Wealth Partners. Today, I want to quickly explain a powerful but often overlooked tax strategy for people with company stock in their 401k, net unrealized appreciation, or NUA. So, what is NUA? When you own your employer stock in your 401k, it has an original cost. That's the cost basis equal to the amount you paid for it in the plan. Over time, if that stock grows, the increase in value is your net unrealized appreciation, or NUA. NUA is simply the difference between the stock's cost and the growth achieved. With a special NUA strategy, when you retire or leave your employer, you can take that stock out of the 401k. The cost basis is taxed as ordinary income in that year, but the growth can be taxed later at a long term capital gain rate, which would typically be lower when you sell the stock. NUA tends to work best for people who have a large amount of highly appreciated company stock in their 401k. Expect to be in a higher ordinary income tax bracket, but can benefit from lower capital gains rates, are at or near retirement and eligible to take a lump sum distribution from their plan, have cash available to pay for the taxes on the shares cost in the tax year of the net unrealized appreciation. The big advantage is tax flexibility. Only the cost basis is taxed as ordinary income now, and the growth can be taxed later at what is often a lower long term capital gain rate. That can translate into meaningful lifetime tax savings. The trade offs: you must take the employer stock as part of a lump sum distribution, which can create a sizable tax bill on the cost basis in that year. You're also taking on concentration risk. If the stock drops after you take it out, you've paid tax sooner and kept a lot of eggs in one basket. Here's a quick example. Suppose you have $400,000 of your employer stock in your 401k. The cost basis is 80,000 with 320,000 in growth. If you just roll everything into the IRA, every dollar you withdraw later is taxed as ordinary income. But with an NUA strategy, you move the stock to a taxable account. You pay ordinary income tax today only on the $80,000 cost basis. The $320,000 growth is taxed later when you sell at a long term capital gain rate. For the right person, that difference, ordinary income on 400,000 versus ordinary income on 80,000 and capital gains on $320,000, can mean significant tax savings over time. If you're a pre-retiree with company stock in your 401k, NUA might be worth a closer look as part of your retirement income plan. I'm Jeffrey Panic, and my new book for pre-retirees walks through strategies like this to help you turn your savings into tax-smart, reliable retirement paychecks. If you'd like to explore whether NUA makes sense for you or learn more about the ideas in my book, reach out and let's talk.